Thank you very much for taking time out of your day to join us for what I hope will be at least an informative review of market history, kind of put into context where I think we are, and then what it all means for markets going forward. There's a lot going on. We have a lot of information to get through, so I'm just going to get started with that. Before we do, just as usual, please take a sip of your coffee and a read of the important disclosures here. Okay, so again, most of you know who I am, but just very quickly, and for those of you who don't know me, been in the business for just about 35 years, been a momentum and trend following investor throughout that entire period, with positions both at Wellington and Fidelity, as well as Thompson Financial. Co-founded hedge fund Breakaway Research, which is another research company similar to the one that I have now, which is MOTR Capital Management Research, the one that you're so thankfully tuned in for. Thanks again so much. I have extensive global U.S. long short investing experience, so basically on both sides of the fence there, if you will. And I've been really the big picture is that if you just think about 35 years, a lot has happened, and through that process, I've learned a lot, did a lot of good things, made a lot of mistakes, and through that 35-year process, I've kind of honed the research process that I have, and that's what I'm going to share with you today, and just kind of put in perspective how I use it, particularly in today's environment where there are so many conflicting messages and possibilities that could lie ahead of us in the next year and beyond that it's really difficult oftentimes to navigate it. So I'm just going to show you where I think we are, and then show you how I'm navigating it based on the complexity of the world. Um, as a quick reminder, mostly to myself, because I almost forgot to mention this, we do have a Q&A session reserved at the end. So along the way, if you have any questions, you'll see that there's a spot to log your questions in. And my son Gavin is in the background there, kind of running the show, and he will organize the questions and put them into a format where we can address them at the end. So please, by all means, ask away. If I don't have the answer, I'll definitely find it for you. So looking forward to getting going here. So a rare moment in stock market history. So F. Scott Fitzgerald has said many things, but he's known for having said that the test of a first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. And I think this is true in life in general, but it's especially true in when you're navigating a complex system like the market, where truly anything can happen. And so the idea is to be open-minded to what might happen, and then just respond to what is happening. And I find that that's always true to be the best way to navigate complexity, but it's definitely true for me, anyways, the best way to navigate the market itself, which is perhaps the best example of complexity we have. So many long-term charts today are at bearish extremes, but they've been extreme for a long time. And we've ignored them for 2 years. And I'll explain to you why we have. But more importantly, why do they matter now? Well, if you know me, you know that my view is that the market is the best fundamental analyst in the business, which is why it is so hard to beat. And so therefore, our edge, I believe, comes from our ability to listen to the market's message better than others, and not only being able to listen to it, but actually do what it says, and kind of check our ego at the door and just listen to what the market says, and refine a better process than others in terms of how to listen to it, but then listen to it when it speaks. Listen, don't argue, right? So these bearish long-term charts that I'm about to show you, that none of them have escaped the market's awareness. It's not like I'm going to show you something that the market doesn't know, but that's the point. Since the last bear market, 2022, the market's chosen to ignore these extremes as they've gotten more and more extreme until this year, and that's what we're going to walk through. So we're going to go through these long-term charts, and then we'll discuss how the market has ignored them until this year, and then now that it's kind of tilting in the direction of paying attention to these extremes, what it might mean for 2025 and beyond. And I'm going to do my best, because I know there's a lot of different types of investors on the call today. Some are more strategic long-term investors who they need to be long no matter what. And others are a lot more tactical and can get short, can get net short. But the point is, as disparate as those viewpoints and approaches are, this information applies to everybody. And I'm going to try to couch it in that way so that you can take away from this information what you really should be taking away. So let's start with where we are historically in terms of extremes. There's many charts that I can show, but I think this is perhaps one of the most important ones. And this is basically showing us how big the largest company is relative to one of the smallest companies in the market. So how do I explain that? So if you, let's just say by way of example that there's 100 companies in the market, and if you were to bucket those 100 companies into four different buckets. The top bucket would have the 25 largest companies, and then all the way down to the bottom where you'd have the 25 smallest companies. What this chart is showing you is a ratio between the size of the biggest company in the biggest bucket relative to the biggest company in the smallest bucket. And so what you're looking at basically is a just a simple ratio between the biggest stock and the smallest stock. And obviously, when this ratio is going up, that big stock is getting bigger relative to the size of the smaller stock. And what we see in history is that this can actually happen because of two different things, completely different things, quite frankly. One would be a bubble, and the other would be a crash. And you see this ratio going to extremes in both of those cases. So in the past, when we've gone to extremes, it's been in bubbles, like the Nifty 50 in the dot-com bubble. And it's basically everything's going up, but the stuff that's going up the most is attracting the most capital, and the companies just become bigger and bigger and bigger relative to their counterparts within the same index. And again, that's typical at the end of stock market bubbles. But we also see them at crashes. And you say, well, how can that be? How can that be? It's because it's the opposite. It's still a ratio. It's still the same ratio. The difference is that the small stock just gets smaller and smaller at a much more rapid pace. So basically, in a crash, you have a lot of stocks that go to a dollar, which makes the ratio between these two skyrocket like this. So the biggest company, even though it's going down, it's not going down nearly as fast as the smallest company to crash. So you end up with these stocks, this ratio going to an extreme also during crashes. And so we have to ask ourselves, well, where are we today? Right? We know for sure that we're at the most extreme this ratio has ever been, and I think most of us would agree that we are not in the middle of a crash. So it's likely that this is more symptomatic of a bubble type environment, and now we have to ask ourselves, is it different this time? That's the most dangerous phrase to utter in investing, perhaps in life, but definitely investing. So whenever you find yourself trying to say, well, it's different this time, you're justifying the fact that the largest company is so big relative to everything else. And just be careful about that. I'm not saying it's wrong. I would never say anybody's wrong, but that's just something to keep in the back of your mind. Don't want to be arrogant about it. Also, going to extremes is the investor allocation into equity. So this is a long-term chart. If you look at the scale, it's back to 1952. And when this dark blue line is equities, I guess one of the alternatives for investing is equities. The other one is debt, and the other is cash. And when equities become such a large part of the investor portfolio, that has tended to happen after very large run-ups in equities. And this makes sense, right? Like during a crash in stocks, nobody's making equities their biggest position. This stuff only happens at the end of large moves in equities. And we can see where we are in context today, all the way back to the 1950s. This is the highest allocation of equities we've ever had. And when you drill down on the foreign holdings aspect of that equation, you have, once again, going back in history, back to the 1950s, the Nifty 50 allocation, the internet bubble allocation, and the current Mag 7 allocation. And this is just American exceptionalism once again. This is not the first time we've been here, won't be the last, but it also won't be the last time that the US stock market is in the bottom of the dumps because it's happened before. It will happen again just because of the nature of how things work. So this is an extreme. And when you just think about it, what's the most likely, what's baked into prices right now, and how much risk is there, room for error is there, or misjudgment is there when you're this extreme. So another important measure is valuation, and valuation is always tricky because in many ways it's an opinion, but in other ways it can also be extremely early and irrelevant until the moment it's not. So this is one of those ones that's been extreme for a while. But as long as the market didn't care about it, I didn't care about it. And so the reason I'm pointing it out today is because if the market starts to care about what the future looks like, where are we in that moment? Are we trading at 10 times earnings? Or are we trading at 30 times earnings or 40 times earnings? Because if the market becomes concerned and we're at reasonable valuations, there's not much to worry about. But if it becomes concerned and we're at 35 times earnings, you might have a problem, right? That's the concern. So this black line is, as I indicate here, is the S&P 500 going back to 1939. This blue line shooting through the middle, it may not be familiar to most, but it's just basically taking it's referred to as trend earnings. So we know over time earnings are very volatile. In any given cycle, earnings can be up 100%, they can be down 40%. It's just very, very volatile, obviously because of the economy is volatile. But that volatility in earnings makes it really hard to pin down what's the right PE ratio. So we've seen things like the CAPE ratio, which is you take a cyclically adjusted earnings and you calculate a PE on that. That's a fine way of doing it. What I'm doing here is all I'm simply doing is I'm basically drawing a best fit line through the earnings over time, just to take out the volatility, and then calculating the PE ratio on that. So you get a trend PE. And when you do that, you can now calculate what's the median PE, what's fair value over this period since 1939. And what should be jumping right off the charts at you is that valuation is in rarefied air. It's not at the highest it's ever been, but my goodness, it's high, right? Now, another thing that might jump off the chart at you is um, if you look at, yes, this is the median valuation, but you can, prior to basically here, 17 times earnings was actually kind of expensive, and it wasn't really cheap until 10. And then something happened here. I have my views on what it is in terms of why, but we seem to have gone into a different valuation regime. And in this new regime, 17, which was expensive back here, is now all of a sudden cheap. So what's the right way to think about this? Well, I think we should just do what it's telling us. We should just create different regimes. And when we do that, we end up with pre-1995 a median PE ratio of right around 15, just under 15, 14 and change. And then when we look at the PE ratio since 1995, the PE ratio is closer to 24. So that gives us a little bit of relief in the sense that we don't have to go all the way down to 17 to get to fair value. But it's also fair to say that we are still in very high valuation relative to even this new valuation regime. So there's still a long way to go down to fair value, even in this elevated valuation regime. So if the market starts to become concerned about something, that the minimum target would be to get to fair value, which is this dashed line, and then anything below that would be cheap. And you can see that during bear markets, even in the new valuation regime, we get to cheap, not just fair value. So obviously the question is, why do valuations matter? I'll just spend 2 seconds on this but it's important enough to spend at least two, maybe three. But the idea is that as investors, no matter who we are, we're all doing this. We're all buying price. And we're doing it for different reasons because we're value investors, growth investors. You could be like myself, where I'm just a pure momentum and trend following investor. But this is what we're doing. We're buying this on the expectation that it's going to go up. But when you look at the formula, no matter who you are, whether you believe in fundamentals or valuation or anything else, it doesn't matter because what actually makes price do what it does after you buy it is some combination of fundamentals and valuation. And obviously, the better the fundamentals and the lower the valuation is when you buy it, the more that price is going to go up over time. You're going to get both great fundamentals, earnings growing, valuations growing, earnings growing, sales growing, margins expanding, et cetera, and valuation expanding. So that's great. That's the home run. But what happens if you have a starting price today of a very high valuation, which we have today? What does that mean? Well, it means it's likely that valuation is at minimum is going to be a headwind. It's not going to be a tailwind to your stock selection. What happens if fundamentals start to turn down? Now you have two things. Now you have deteriorating fundamentals in an environment where there's an extreme valuation. Just don't have to forecast anything. In that scenario, what happens to price? Right? I don't even have to answer the question for you. This is why valuations matter, but they don't matter until the market tells you they matter. And that's the point that I'm trying to make today is that I've ignored valuations for a very long time, and it's been right to do so because they've been expensive, but it hasn't mattered. But it matters now, and I'm going to make that case. So taking that same valuation chart, which you see here, and overlaying it with a chart of the stock market relative to gold. So this is just another ratio, if you will. So you just stocks divided by gold. And just like the other ratio, if stocks are doing better than gold, that ratio is going to be rising. And if stocks are doing worse than gold, that ratio is going to be falling, right? What we notice over time is that valuations tend to expand. So this, again, the black line is the PE ratio, tends to expand when this line is rising. Why does this line rise? Well, what's happening when this line is rising? It's when stocks are outperforming gold. And the opposite is true. Valuation contracts when stocks are underperforming gold. So we have that as a base framework. Unfortunately, what we know is, as I said earlier, valuations are at an extreme and they just went to a whole new extreme in this Mag 7 environment that we're in. The problem with that is that the ratio between stocks and gold did not confirm that high. And when you look at this last trend here, you can see that as the valuation expanded, the ratio of stocks to gold went up with it all along the way. This time we have a divergence where it was not confirmed, that latest valuation expansion was not confirmed by this relationship. And not only that, it's begun to roll over and break its trend. So now we now have to be open to the possibility that with the S&P underperforming gold, it implies lower valuations. That's fine if you're already at 10 or 15 times earnings, but you're not. You're at 32 times earnings. So valuation compression from here matters. Think about that formula I just showed you. So none of this, of course, has escaped Warren Buffett, who now has a record cash position in terms of his portfolio holdings. And now we know something about Warren Buffett's acumen. We know that he's an incredible investor, obviously one of the best in history. But we also know he's very early. So we know he's early, but we also know that he's never been wrong. So I've known for years, and just look at this chart. You can see that he's been raising cash for a long time. I've chosen to ignore it because the market didn't care about that at that time. But now that the market's beginning to inflect again, which I'll show you, now I have in the back of my mind, knowing that I've kept it on the back burner, that Warren Buffett's been raising cash, but I think it's now time to pull that concern to the present, and pull all these concerns, all these charts, pull them to the front burner because the market's saying they matter now. And it's probably worth noting that Warren Buffett over the past, this is the dollar value of his stock purchases of his own stock repurchases of his own company since 2020. And in the last 2 quarters, he hasn't bought back any of his own stock. It's what people say versus what they do. Now, all of this, as I just detailed, these are all examples of where we are in terms of extremes in history relative to valuation and positioning, and some pretty smart investors doing what they're doing, et cetera. Different relationships between stocks and gold, and valuations expanding and contracting, et cetera. Knowing all of this is as of March 14th, so a pretty recent chart. And this is from a story from MarketWatch, and it's basically showing us the year-end target for the strategists on Wall Street. And usually there's a few bears on here that have a really, really kind of ridiculous downside target. And then there's some really, really uber bullish people, but you end up with an average. And this, as of recently, because a number of I won't mention who it is on this list because it's not the point. It doesn't really matter. This is a really tough business. So pointing fingers at others is disgraceful in my view. All I want to do is just point out, and the most bearish investor on this list is actually quite bullish. So there's nobody here on this list that's expecting the market to be down by the end of this year. Now think about all the extremes that I just told you. And if I'm right at all about the possibility that things are inflecting negative, not a single Wall Street analyst, strategist on the street is expecting a down market. So the worst case scenario is 9%, and that's an average to slightly better than average return for the market going back to the early 1900s. That's the worst case expected scenario. The best one, of course, is 25%, and the median is a 16% gain. And keep in mind that we just had 2 back-to-back gains of high double-digit returns, supposedly. And I'll give you some insight as to what I mean by supposedly in a moment. But the idea that we get another high double-digit or high double teens return from here is kind of interesting when you think about what the backdrop looks like. So why does all this stuff matter now? It's you look at those charts, you can see that they've been extreme for a while and just getting more and more extreme. Why does it matter now? I say it's because the market says it matters, finally. The market's favorite game is a shell game. And it likes to hide the truth from you when you need to see the truth the most. The market does an exceptional job of hiding the truth from you when you really need to know the truth. So we all know this bear market started in 2022, went down 28%. Since then, the market, quote unquote market, has been on a tear. And if you look at this, there's nothing to see here, folks. Everything is just fine. This is just another pullback in a long run of pullbacks that we've had in this ongoing bull market. There's no bear market concerns to worry about here. If you're looking at this nut in the shell game that the market's playing with us. But if you look under this shell, it's a different story. Most people would be surprised to know that the average stock, as represented right here by the value line geometric average, so this is just what the average stock is doing. The average stock is actually down 20% from the 2021 peak. So it's interesting to note, first and foremost, that this index peaked before the market, before the S&P, giving us a warning that this was coming. And our risk gauge did, which I'll show you in a moment, did a great job of foretelling that. Um, and yet the S&P is now up here somewhere, and the average stock is still down 20% from this peak. There is a massive disconnect. The market, the S&P, is lying to the point where, just to put this a little bit more perspective, the the average stock today is below where it was just before the banking crisis happened in the US here in early 2023. So that seems like something that's long in the rearview mirror and doesn't, it's no longer a problem. The average stock is actually below that level today. And again, I've known how I've written about this divergence. You folks on the call to get my research and investor letters know that I've been writing about this for 2 or 3 years now. And I've been coaching and counseling people to ignore it because it doesn't matter. And obviously, I'm changing my tune now because things are starting to change. And I'm going to show you why this matters. But before then, let's just take a look and maybe why is this massive disconnect taking place between the largest companies and the average company, the average stock? And we can see it here. This is the earnings for the S&P 500, right? And if we look at we put this into the schematic of the bull and bear markets we've had. This was the peak in 2020, 22, 21. As I told you, there were two different peaks there, and earnings went down as is typical after the market peaks. And then it appears that the market has taken off again. Well, it's true that the S&P has taken off because this is largely driven by the Mag 7 earnings. But look at what the rest of the market has done. Earnings are nowhere near where they were at the peak of the last bull market. This is why we see this divergence. And it's as always, these big trends are caused by fundamentals. So we have this massive divergence in earnings, and it's why there's a big gap between these two. And you'll note that the last time we had this was in 2018 and 19, which was a highly bifurcated, very unhealthy environment that happened to be followed by COVID. So I'm not saying that this divergence happened because the market knew COVID was coming, but I am saying that when COVID hit, it's likely why the market just immediately began tanking because the underpinnings of the market were already very weak to begin with. So we've seen this before, and we need to pay attention if the market starts to indicate that it's turning down. As with this as a backdrop, we need to pay attention to that. So when we look at where we are today, we see these are the Wall Street's earnings revisions, and the orange line is the earnings revisions for the non-Mag 7 stocks in the S&P 500. And we can see that up until like the last at around 6 months ago, these earnings revisions started to really taper off. And in that moment, that's when we really started to see these jaws open wide open again between the Mag 7 and the other 493 companies. But here's the problem. The forward earnings revisions are starting to deteriorate even for the Mag 7 to the point where they're now both negative. If you look over here, you can see that they're both now below zero. The last time we had that was, guess when? The beginning of the 2022 bear market. So the up until recently, until the market began to deteriorate, I've acknowledged this difference, and I was open to the idea that this could resolve bullishly. And I'll show you in history when we've had these divergences, it almost always ends badly, but it's not always. Sometimes it resolves bullishly, and when it does, it can actually be extremely bullish. So because of that, until the market told me I need to worry about this, I was actually open to the idea that we could resolve higher. So here's a chart of this was the S&P 500, the black line, back to 1974, 1975. And this is the value line geometric average, that what the average stock is telling us. Right? And during bull market environments, you'll see that when the S&P is going up, the average stock goes up with it. Pretty much no matter where you look in this chart, when the S&P is going up, this average is going up with it, confirming what's happening, according to what the S&P is trying to tell us. So what we want to know, though, is the S&P telling the truth? So when the S&P goes out to new highs, is the average stock going out to new highs with it? And in this particular case, we actually had a double kind of like minor dual divergence here. And this resulted in, it doesn't look like a big decline, but it's because of the scale on the right. That was a 20% decline in the market. When we fast forward to the internet bubble, That last phase of the internet bubble was pretty much only the internet stocks going higher. The average stock peaked back in 1998, which you can actually sounds crazy to think that, but you can look at it. This is 1998. That's when the average stock peaked and did not participate in the bull market. And so when the market said, okay, it's time to pay attention to this divergence, that opened the floodgates to a 50% decline. This particular one was a 58% decline, but it was more coincident. But you can see they moved together. And then we had, as I mentioned just recently, the 2018 to 2019 period was very bifurcated, very disjointed beneath the surface, happened to be followed by COVID, but nonetheless, it was still forecasting a bad outcome. COVID just made it accelerate into a 36% very rapid decline. Now, if you're looking at this chart, the really observant might notice that there was a period where the market went up and the average stock did not go up, but it was followed by a bull market. This happens to be the window of time where it was the European debt crisis. I was at Wellington at the time. It was a really tough environment for stock selection, et cetera. But it resolved into one of the most robust, powerful bull markets I've ever managed through. So for this reason, I was willing to ignore this bearish divergence, which is glaring. It's probably the largest one on the chart. I was willing to ignore it as long as the market gave us hope, if that's not a good strategy, obviously, but gave us indication that this might happen. As long as that was potentially on the table, I was willing to wait. But as I'm going to show you as we go, that's no longer on the table. So the more normal outcome to this kind of a bearish divergence is what I'm most concerned about. The MOTR risk gauge. This is what I use. Again, our research clients and investors are familiar with the risk gauge, and it's basically what I refer to it as is our lie detector or our truth serum, and it's what we use to determine whether or not the market's telling the truth or not. And so, what's in the risk gauge are concepts that I call inviolable. They're first principle types of inputs. So they're things. There's only 5 of them, and they're all technical, by the way. They're not fundamental. They're not interest rates, what the Fed is doing, what valuation is, or anything like that, because those things don't have to be relevant in the moment. Things that are in this risk gauge are things that must be true. So like just to give you a really simple, but it's painfully simple, but perhaps why it's so powerful, you will never in your life ever see a bull market that looks like this. You will never see a bear market that looks like this. That's inviolable, right? It's a first principle to trend following. Concepts like that are inviolable. You can never have a bull market without this or a bear market without this. Those kinds of concepts are what make up the risk gauge. So they're inviolable and they're based on first principles. So what we have is when we aggregate those 5 principles, those first principles across 3 time frames, we have a long-term time frame, which is like the quarterly chart. This is the monthly chart, and then this is the weekly chart. So just want to remind you that when you see me talking about short term, I'm not talking about 5-minute charts or even hourly charts or even daily charts. I'm talking about my short-term chart is the weekly chart, which is most technicians' long-term chart is the weekly chart, which is not a criticism. It just is what it is. Most technicians are more tactically oriented, and the weekly chart is probably as long-term as they should look if they want to be tactical. But because I'm a long-term trend follower, my short-term chart is the weekly chart. And so what we're trying to identify is, are we in a risk-on environment, a mixed environment, or a risk-off environment? And this is critically important because what it tells you is what you should do with the next oversold condition or during periods of market weakness. Should you be buying it or not? Or even if during periods of market weakness, should you be selling it? Or during periods of market strength, should you be buying it? Like if a stock is breaking out or the market is breaking out, should you be buying that breakout or not? Should you be selling it? Should you be shorting it? Those are the distinctions that this risk gauge is trying to help us identify. And when we're in risk on, we want to focus on trend following, which means just basically buy and hold the trend as long as you can. Stay fully invested, no short exposure in a bull market when you're in risk on. You want to be buying weakness and you want to be ignoring overbought. Overbought's good in a bull market. It's the reason you got long to begin with. You know, the more overbought, the better. So a good example of overbought is when something breaks out of a sideways consolidation, if you will. That's about as extreme overbought as it's been in a while by definition. That's good. In risk on environments, you want to buy that. Then so the risk gauge will look something like this. When it's in mixed, the risk gauge will look something more like this. And this is not bullish, it's not bearish. What does that mean? Well, it means exactly what it says. It's mixed. So when and in this scenario, you want to be very tactical. So you want to reduce your risk overall because there's no reason to be max risk in a non-trending environment. But you also want to be flexible in your execution of your strategy. So if you're a long-term trend following or a long-term investor allocator and you're in a mixed environment, you don't want to be chasing the market higher and adding when it's overbought because the market's in a range-bound environment and you're going to be buying the high. You want to wait for the market to get oversold like it is now. If you're more tactical, then you want to be buying when the market's oversold or after periods of market weakness and selling after periods of market strength. And if you're an aggressive tactical investor, you can get short. So regardless of who you are, you can translate where the risk gauge is into your action plan for the day. And if it's mixed, just remember that both oversold matter and overbought matter. Whereas when you're risk on, overbought doesn't matter. As no matter, the more overbought it gets, the better. But when you're mixed, overbought matters. You should respond to it. And if you're long term, that means don't be buying. If you're short term, that's where you would want to be selling and perhaps even shorting. And then, of course, the one we all fear and not a fun place to be is this risk off. And this is what the gauge looks like when it's in risk off. In this scenario, you should have high cash balances, super tactical. You can have short exposure on if you're so engaged, if you're so inclined, and if that's part of your mandate. But here you want to sell overbought and you want to ignore oversold. So, like in risk on, you want to ignore overbought. When you're risk off, you want to ignore oversold conditions because you're in a bear market. In oversold conditions in a bear market are emblematic and symptomatic of bearish conditions and likely will be followed by lower lows. So you want to be patient, retain your cash balances, and wait for the risk gauge to inflect. Just by way of example, we have this all the way back to 1950, but I'm just going to very quickly walk you through how this can help you navigate even a very turbulent moment like the global financial crisis. At the first quarter of 2007, we were still in risk on. We were in risk on for a while. So risk on means what? I just described it. It means buy weakness, buy breakouts, ignore overbought. So this is where we were in the first quarter of 2007. At the end of the second quarter of 2007, we can see that we've dropped into mixed. So we're really focusing on this medium-term time frame. This is the monthly chart. So this is a very long-term chart. And so with this indicator dropping to mixed, despite the fact that along the way the market went out to new highs. Went out to new highs here, and yet this risk gauge still dropped to mixed. Is your warning that the market's lying? It's not nearly as healthy as it's trying to tell you that it is. So fast forwarding to the next quarter, and we have a significant drop in the monthly time frame. Now, what does that mean? Well, it's still mixed because this is still up here in risk on. But so therefore, it still means buy weakness and sell strength. So if you were a long-term investor, this is a terrible place to add more money. Let's say you just got a $1 million allocation from a client, and you're asking, should I put the money in now? This is a terrible place to do that. You should wait for it to get oversold. That's the way you would use this. If you're more tactical, perfect place to sell whatever you bought for a trade or even get short if you're that aggressive. Moving to the next quarter, we ended up with the long-term, again, this is the quarterly chart, falling completely out of risk on, and we now have the monthly gauge in the bottom half of mixed. This is where you can actually really entertain the idea of the next overbought condition, you should be shorting, or the next overbought condition, if you're a long-term allocator, you should be raising cash. Definitely not, allocating that incremental $1 million that you got from your clients in terms of new assets. So when we fast forward to the next quarter, we're now in risk off with the monthly time frame in risk off. Next overbought condition is where you want to take very defensive maneuvers, whether it's raising cash, resisting allocating that new $1 million, or getting short if you're aggressive. And of course, as you can imagine, if it was already bearish by then, the risk gauge stayed bearish all the way through the GFC. And then at the bottom, which it did not do, there's no effort here to call the bottom in any of the work that I do. But at the bottom right here, it did go to mixed. So now you're much more taking on more risk. You're trying to buy weakness, buy oversold conditions, perhaps selling overbought conditions. And then as you go into the next quarter, we're back in risk on, and we're no, as you can read here, it's buy weakness, buy breakouts, no short exposure, fully invested, etc. So this is one example. We're building videos to show this risk gauge through the various bull and bear markets back to the 1950s. We have them done so far back to 1987, and we're going to be building videos on them and sharing them with clients. So if you're interested, you'll see those coming in time. But for now, let's move on to where we are today. This is where the risk gauge is today. The quarterly risk gauge fell out of risk on. This risk gauge, the medium term risk gauge is still just slightly above mixed. So what does this mean? Hopefully by now you can almost tell me what it means. It means mixed. It means respect oversold conditions, and it means respect overbought conditions. Okay, I'm an allocator. I just received $1 million allocation. What should I do? You should be buying. You should put that allocation to work. Overall, in a defensive framework, in a non full risk on framework, however you define that in your practice, in that framework, if you get another $1 million in and the market's oversold, this is where I would rather be adding to that allocation. If I'm a short-term tactical trader, I want to be taking on short-term trades with the expectation that I'm going to sell them the next time the market gets overbought. And I'm going to show you those levels in a moment. So this is where we are. We're very tactical. Now, the problem is that when you go from in 2022, these risk gauges were all down here at the bottom. When you go from extremes like this, and then you work your way all the way up to risk on, and then you start to inflect down, it has never gone back to bull market. So the best case scenario is that we have a sideways market. So what we're trying to do is in any given window of time, the market can either go up, down, or sideways. And that's an obvious, painfully obvious statement bordering on stupid, but sometimes those are the most powerful statements because it enables you to really concentrate and focus on what the task at hand is. If we have enough evidence on hand to eliminate one of those three scenarios, we're left to invest for the other two. And what this is telling us is that we can eliminate this from the scenarios. So what does that leave us? It leaves us with this or this. Right now, it's neutral, right? So that leaves us with this is our base case scenario. This is our worst case scenario. And in time, my suspicion is that this will continue to deteriorate, and it continues to deteriorate each day, actually. And if this gets below the midpoint of mixed, and particularly if it gets down into here, we by then will already have evidence that there's an impending bear market. And so already we've taken down risk. We've already begun to respect overbought conditions, adding to short exposure if that works in your mandate. But we're not in a risk on environment. So however that works in your framework, take your risk down and in respect overbought and oversold conditions. Now, one of the most important inputs to this risk gauge is one that I've already shown you or discussed, which is price trend itself. As I said earlier, you'll never see a bull market that looks like this. So obviously, given its importance, I track price trend in 3 different time frames. And I just want to reiterate again, this long-term trend is the quarterly chart. This is the monthly chart. This is the weekly chart. And when you look at so these are the various forms of uptrend. So an uptrend is a chart that looks like this. An up base, well, I'm just going to use both of these together. An up base is a chart that was trending higher, but has since gone into a base. It's kind of lost its momentum. It's not going down, it's not bearish, but it's also not trending. It's this kind of trend that you want to respect overbought and oversold. And so those are the 3 possible bullish scenarios. When you, in this time frame, add up all of those, you get 45% of the market, which means 55% of the market looks like this. In fact, the biggest bucket right now, again, I want to stress this again on the monthly chart. The biggest bucket, 42%, looks like this. So if you believe the market is good at looking forward and assessing whether good things are happening on the horizon or not, which obviously I do, you have to ask yourself, why does the risk gauge look like this? What's the risk? What's the market picking up on that I don't see? Or perhaps you do see it, but you've been seeing it for 2 or 3 years, and the market seems to ignore it. What I'm saying is those things are coming together. It's like the perfect storm where you have all these long-term problems on the horizon that inevitably have historically ended in bad scenarios. But you now also have the confluence of the market telling you vis-a-vis at least there's one messaging process, which we call the risk gauge or the truth serum, is now coming together and saying these things matter now. And so at this point, we're still neutral, but we're leaning towards expectations that in time this will begin to roll over, and we already see it here. We're only 45% of the market is in some form of an uptrend, and 42% is in a clear downtrend. So what does that mean? Well, it means it looks like this. And so when you rally and you get some sort of a strength in the market, that's rallying into a downtrend. So it's not rallying into an uptrend. It's rallying into a downtrend. So in 40, 55% of the market on a monthly chart looks like that. So this is just something not to ignore. So once we've been given the heads up that from the market and vis-a-vis the risk gauge that we need to like begin to look at these other things that are they're really important, but they're not in the risk gauge because they don't always do the same thing in every bull and bear market. The risk gauge is telling us go look at those other indicators to see what they're doing because if they're starting to tell you that things are shaping up poorly, it's all the more reason to pay attention. And when we do that, this is the first thing I look at. There are in the motor universe, we have 27 groups, which is a little bit more granular than sectors, but it's not quite as granular as industry. So you get a bit of a better grouping in between there. And there's 27 of them. And what we do is we rank them according to their momentum score. And it's a pretty powerful but basic concept. And what you can then do is just sort them by the best to worst momentum. So now you know where you want to invest. That's the first key takeaway. But then you say, okay, well, where do I want to? What's the market trying to tell me to do? Well, right now, the market is trying to tell us to buy this. Number one, first and foremost, precious metals. I mean, bull markets are not led by precious metals. Sometimes they are, but they're not led by precious metals when they're also being led by utilities, newspapers and media and radio, insurance companies, and banks. This is like the epicenter of safe havens, and they are all in the lead. And then when you look at the bottom, it's a who's who of things you want to have leading in a bull market, and they're all at the bottom. So I will tell you that for the past 2 years, one of the things, in addition to the risk gauge being bullish to begin with, what kept me bullish was that this rank sort was very cyclical. And you can see now that it's not cyclical at all. In fact, the market appears to be hunkering down for something on the horizon. Now, and perhaps most importantly, at the bottom, you see the semiconductors and biotech at the bottom. These are like go-to bull market leadership. And so you want to be making sure that you're paying attention to what's at the bottom of this rank sort. And what's down there is stuff that usually leads in a bull market and does poorly in a bear market. So you can take the same exact list and resort it. And just to see like where has capital been going over the past 3 months. So these are the ranks over the past 3 months, 6 months. This is where the ranks were 12 months ago, 9 months ago, et cetera. And this is again where it is right now. And all I'm doing is taking that same table and sorting it by this column, the most positive gains in the momentum score. Instructive to know in and of itself, but now let's look and see where it is. Pharmaceuticals, telecom, precious metals, media, healthcare supplies, services, staples, utilities. This is the market telling you that it's hunkering down for something negative on the horizon. Okay, well, let's ask the opposite question. Where has capital been flowing out of? It's literally the who's who of where you want to be in bull markets. It's industrials, and industrials have been leadership for two. Industrials started leading in 2021, 2022, right at the beginning of the bear market. And that was the market's way of telling you that when that bear market is over, industrials are going to be leadership, and they were. They led all the way through up until just recently, and you can see that these scores are plummeting, right? So this is what's happening beneath the surface. This is the way the market tells us what it sees coming on the horizon. So there's other ways you can do this with a chart, and this is looking at consumer discretionary versus staples. And what we're doing here is comparing things like how are companies that sell cars and houses, which are very cyclical and would depend on a strong economy to do well, how are those companies doing relative to companies that sell toothpaste and food, which are going to sell products no matter what? What we find is that these kinds of companies start to underperform these kinds of companies before the market even tops. It's another way that the market lies to us about what its intentions are. So when the market was going into its peak in 2000, this ratio turned down. Again, this is a ratio just like the other ratios. At this peak, same thing. And when you look back at all the big peaks we've had, this has been a very good telltale sign of the impending bear market in equities. A little bit more generic, not necessarily focused on consumer discretionary, but we can talk about high beta versus low volatility. High beta stocks tend to go up and down more than the market. Low volatility stocks tend to go up and down less than the market. So in bull markets, high beta stocks outperform. In bear markets, low volatility stocks outperform. And what we find is that, as another ratio, high beta stocks begin to underperform low beta stocks or low volatility stocks before the market even tops. And we see that playing out once again in all of these bear market tops. What's really interesting about this ratio concept is you can take it outside of equities. You can and just see what the rest of the asset landscape is saying. So let's look at bonds and let's see what they're saying. So this is looking at riskier bonds versus safer bonds. So this red line is just what's called the high yield credit spread, and it's how much yield premium investors are demanding above high quality bonds in order for them to stay invested in a highly risky bond. And you can see this sort of line in the sand is 3.5%. When we see this credit spread accelerate rapidly above 3.5%, while the S&P is going out to new highs, that's the way this is the credit market telling us that something's wrong. And of course, this one happened. This was on the forefront of a significant credit bear market. But again, when you look at all these accelerations through 3.5%, they all happen right at major turning points in the market. Now, we don't have an acceleration through 3.5%, but we do have acceleration. And we have these other things that are telling us perhaps that an acceleration through 3.5% is coming. So we want to be mindful of that as well. But you'll notice as well, just to give you an example, you can see that there was several accelerations through 3.5% in through here. And there was some in through here as well. So it doesn't always signal bear market. So this is why it's not inviolable. This is why it's not in the risk gauge. But once the risk gauge has told us, we need to pay attention to things like this. If this accelerates above 3.5%, we're going to have reason to be concerned. Okay, one last one. This is looking at even a different asset class, and this is commodities. So what we're looking at is industrial metals versus precious metals. So industrial metals are things like copper, tin, aluminum, steel, things like that, things that are really in high demand in economic booms and strong economic times. And precious metals are things like gold and silver and platinum and things that are more in demand during uncertain times. And once again, as you can imagine, industrial metals begin to turn down before relative to precious metals before major market tops. Not always. You can see one here that turned down after, which again is why it's not inviolable. But it's very reliable over time, especially if you have this confluence, as I referred to it earlier, as a perfect storm. Now, it's looking at this current divergence. I mean, it's easily the biggest divergence on the chart. So the market has been telling us something for 3 years now. And remember, this is where the market peaked in 2022, and I showed you that the S&P is up here, but the average stock is actually down here. So the average stock has done this, which is a lot more in keeping with this. So this is the market is lying to us, right? And it's lying to us with the backdrop of extreme valuation positioning, American exceptionalism, all that stuff. Going forward, as I said, we're very much neutral. I'd almost refer to it as table pounding neutral, which means we want to respect oversold and respect overbought. Again, that means different things to different people, but what should be important and the same for everybody is the levels at which you consider those overbought and oversold conditions. And so that's what I'm doing here. So part of what we do is we have this systematic trend model that calculates trend definitions. Remember, I showed you uptrend and so an uptrend looks like this, a base of an uptrend looks like this, and then a downtrend looks like this, and a base of a downtrend looks like this. So we know that this is the S&P ETF. We know across the 4 time frames, and I'll explain that, this is the trend. So this very long-term chart is the yearly chart. So we're talking very long-term, fundamentally driven trends. And I very rarely, even in my research clients would know that I very rarely talk about this because it's so irrelevant often. But now that it's possible that the market's inflected negatively, this time frame now becomes very relevant, and I'll show you why. But still focusing on this is the time frame that we want to make sure we get right because this is the monthly chart. It's still in an up base, but it's in a base because it lost its momentum. It's no longer trending like this. It's lost its momentum. It's doing this. And the way it loses its momentum is it closes or breaks below its momentum zone. And that momentum zone now becomes resistance. So what's the line in the sand between this up base becoming, going like this as a base and then going higher again versus going into a base and then going lower? It's this zone right here. And so you can see that the spider ETF is there right now. It's sitting right in the middle of it. And so again, if you're a tactical investor, this is not where you get short. This is the worst place to get short. If you're a tactical investor and you want to get long, this is where you get long. If you're a long-term allocator and you just got $1 million in allocation, I would far rather put that money to work here than up here. What's this level? It's a combination of these two red zones. So this green box is a combination of these two zones. And this red box is a combination of these two zones. And the problem is for us as investors is that once you get up here, it's going to feel better to get long because you've gotten some relief and maybe you're thinking the whole thing is over. But the context is the market's lying. It's not as healthy as it looks. It looks nothing like this, as I showed you with the average stock. And so this in my work I would refer to as a broken market. And right now we're an oversold broken market. And all we're going to do is rally across the range and become an overbought broken market, which sets the stage for potentially ultimately this. And if that ends up being the case, that we end up resolving this like we have every other highly divergent extreme environment where the market actually finally cares about those extremes, the minimum downside would just simply be that you do a cyclical bear market. And typically in a cyclical bear market, you go to the momentum zone of that long-term yearly chart, which is down here. So for me, if I'm a allocator and I'm getting assets through the door, I want to allocate only in this green box, definitely not up here. Tactical investors should be getting short up here. You can even start getting short now if you're really aggressive, but just keeping everything small. If we're below here, this zone, everybody should be ignoring oversold conditions. Remember, if we get below here, that's very likely going to coincide with the risk gauge going into risk off, which means oversold conditions no longer matter. So we're in this environment here where overbought conditions don't matter. The more overbought it is, the better. If you're in a downtrend, oversold conditions don't matter until you get to a level where it might matter, right? So that's how I would put this all together. If you're below 550, you're going to want to pay attention to that deterioration. We have a few minutes left here. I'm just going to quickly run through these charts. These are charts that are, I'll just fly through these. The video will be available for recording, so you can kind of get the bulk of what we're talking about here. But this is another ratio. This is the U.S. versus the world ex-U.S. And you can see there are times when the U.S. underperforms, right? It's also underperforms, and now we're in a massive run of outperformance. This has gone on for a very long time. This is that whole American exceptionalism thing. What we do know, though, is that it's begun to show some significant underperformance. It's done that many times during this trend, so it's too early to say it's over. But when you do rank the regions, Europe is now number one, and the U.S. is number four. And for years, the U.S. has been either number one or number two, wrestling back and forth with the other regions, but predominantly the Middle East. So right now, this is the risk gauge for the rest of the world ex-US. And you can see that it's better than the US, but it's also not good. So it's way too early to get excited about Europe. But I think that chart's going to matter over the course of this year and the next few years. Continuing along, this is a break of the 10-year Treasury yield, 40-year downtrend. I think this is going to matter. This is the inversion of the yield curve. This very relationship is what got most people bearish, because when the yield curve inverts, you're guaranteed to get a recession. This inversion lasted so long that people gave up on that idea, probably just when they shouldn't have. And so, because when the curve finally does normalize, that's when you get downturns in the market. Future excess capacity. I mean, this yellow line is the U.S. government's spending on R&D back to 1960. The orange line is the CapEx spending of the Mag 7 over the past 10 years. And this is very reminiscent of the CapEx spending from Y2K that happened all in preparation of all the computers crashing. So you better get new computers to keep up with the new, the turning of the clock from 1999 to 2000. And everybody spent all that money on CapEx only to discover they didn't need it. But now they have all the CapEx they need for the next 5 years, which was part and parcel for why technology underperformed for so long. This is the dollar going back to 1960s. Note where it has tended to peak and note where it has tended to bottom. It bottoms at major structural bottoms for the stock market, and it has tended to peak at major tops for the stock market. And then lastly, the shell game fools even the best of us. So this is the Dow back to 1920 to 1933. And Irving Fisher was a very highly regarded economist back then, said stock prices have reached what looks like a permanently high plateau. Unfortunately, he said it right here. And so these are the kinds of things that are not said at market bottoms. They're said at market tops. And unfortunately, we just had this headline come across our email not too long ago saying that the world economy has exited the boom-bust cycle. Given that that's never been true in history, I'm doubtful that it's true. But the point is, these things are never said at the bottom. They're invariably said at the top. I'm going to just put up these takeaways and see if we have any questions queued up for us here. How do you think about tactical stock selection in the current? Yeah, so tactical stock selection to me is, if assuming your question is literally tactical, I'm perfectly fine buying higher beta things down here, obviously with stops. And because we're in a very transitionary tactical environment, whatever I'm doing here, I would just keep it on the smaller side. So don't not do it. Don't fail to respect that oversold condition. But what you want to respect is that it's a deteriorating environment. So on the one hand, you want to respect the oversold condition by on the one, if you're tactical, buying things that have a decent chance to, rally across the range. If you're a strategic investor trying to be tactical in this window of time, I'd far rather allocate here than with the market up 5% from here. Do you spend more time looking for traditionally good charts in leadership sectors? So this is a really important question. I'm so glad it was asked. The problem is that during bear markets, I mean, real bear markets, there's this notion that correlations go to one. And so during this transition phase, even if we're tactical, we might be trying to find things that still look good. The problem is that when you do that today, most of what still looks good, I just showed you the list. It's all defensive things. It's all like utilities and staples and things that are just like are not going to really do well for you over time. But the problem with it is that in a real bear market, everything goes down. Correlations go to one, meaning everything goes down. And so that includes even the things that you went to seek a safe haven. And so the good news is they are likely to go down less. So if you're looking to protect yourself and go down less, that's exactly what you should be buying is good charts in that list of top 10 groups that I showed you earlier. But if you really want to be tactical and respect the fact that this could be on the beginning of a cyclical bear market, then what you really want to do is respect that notion that's really hitting you over the head, which is like this is deteriorating. That's the most important thing. And so therefore, to the extent that I'm doing anything that's tactical in a higher beta name, it's a name that hasn't broken yet. It's a name that still has, maybe still is sort of like it's in an uptrend, but maybe it's in a base and it's oversold in that context. In other words, I'm not buying anything that's in a downtrend today, even for a trade. It's just we're too past that. Generally speaking, in bull markets, you can buy things that are in a downtrend because the bull market will bail that out and it could end up being a great trade. And sometimes I actually do that. But when you're transitioning to a bear market, presumably that's what we're doing. The last thing you want to be doing right now is to be buying the things that the market's telling you to sell. So if you want to do tactical, it would be only in those charts that are tactical trading. It would be only in those solid leadership cyclical groups that are still trending, not in a downtrend yet. So I'm a long-term trend follower, and I would have a third allocation to that long-term trend following portfolio, and then the rest of it is allocated towards building the proper positioning for this impending bear market, which will eventually include short positions if the environment continues to deteriorate. But I'll only put the bulk of those short positions on when the market's overbought. So the market's oversold right now, and I'm just not interested in putting those shorts on. But the idea is, like, I can tell you how I define a de-risked portfolio, but it's not relevant because in the context of not knowing the full range of what I can do, it's not going to help you. What I would just say to you is in your definition of your range of risk on versus risk off, I would be leaning towards at best neutral in that environment, looking to get more risk off as the market gets overbought. Thoughts on oil and gas, natural gas. So, when you look at where the sectors that are tied to oil and natural gas are in the ranking right now, they're all at the bottom. And they've been at the bottom for a long time. So in oil looks like it's setting up to take another leg lower. I have to say that natural gas actually does look really attractive to me, technically, but they don't call it the widowmaker for nothing. I mean, I watch it every day, and it's got like a 2 to 3% volatility every day. So even if you're going to do that, just because of this environment, keep everything on the lower side of risk. But on things that are really volatile and really risky, I would take the risk down even further because in bear markets, correlations go to one, and that means everything can go down. So look at what gold did during the global financial crisis. That's the safe haven of safe havens. It still went down. And the reason it goes down is because in a bear market, especially if it gets really bad, in a bear market, you sell what you can, not what you want. And if the only thing that has a bid is gold, that's what you sell. And so gold goes down in a bear market too, even though it's the best safe haven that you could choose. Hopefully that was helpful. Speaking on the Dow Theory, yes. So the Dow Theory is it's another one of those things that I could have featured. It's one of many things. It's not in the risk gauge because it's not always the case. But if you look at Dow Theory today, for those that aren't familiar with it, Dow Theory is basically taking the industrial companies and charting them relative to the transportation companies. In the theory being, this is something that Charles Dow created back in the late 1800s it's why he created these indices because he believed there was wisdom in price and the market would figure out the fundamentals in the ebb and flow of the fundamentals better than anybody. So he created these indices to track that. And what he discovered was that when these two things are moving up together, that's a sign of a healthy economy. When the market's moving higher, but the industrials turn down or the transports turn down ahead of one of them turns down ahead of the other before the market peaks. That's another way of the market concealing the truth. The undertone of the market is trying to tell you that things are beginning to deteriorate because if you think about if industrials are doing really well, that means they're going to be shipping a lot of things. And so if that's true in the industrial charts moving up and to the right, so too should be the transports. But if one of them starts to turn down while the other is not, that's the market's way of telling you that something's coming unglued. And that same thing happens at bottoms as well. One gets better before the other. And it turns out that right now there is a glaring sell signal from the Dow theory in that the transports are turning down before the industrials. So I could put that as another indication that the message of the market is hunkering down for something less than happy, if you will. I don't want to be too extreme here on the horizon. So banks are interesting because, and this actually may be more relevant now than ever, but prior to the global financial crisis, banks were relatively defensive. Like I wouldn't say they were defensive like utilities or staples, but they were relatively defensive because they're kind of mundane businesses. But what we knew about what happened after 2000 and into 2007 is they became anything but mundane. And they started structuring all those products that essentially blew up their businesses and nearly blew up the world, the financial world. And so what ended up happening as a consequence of that is they just got they're basically like utilities now. They're so regulated that they're essentially utilities. Their balance sheets are pristine according to the research that I'm reading. So I would say that they're back to being what they've kind of always been. Always, that's a very risky statement because they do tend to go off the rails. You can think about all the banking crises we've had. Say it this way: we've had many banking crises, and during the crisis, you don't want to own them, obviously. And in a real crisis, you don't want to own anything. But immediately after the crisis, those banks get so surrounded with regulation that they're probably Fort Knox. They're probably one of the safest sectors on the planet. Probably, no guarantees there, but the idea is that they're basically so regulated right now that they're like utilities. So the fact that they're in leadership right now is to me the market's way of telling us that the capital continues to flow to the safest of the safe. And let's not forget that the number one sector or group in that listing is precious metals. How do you know? Great questions, by the way. Thanks so much. How do you know if the bear market is more like 2022 down 27 or something like the GFC? I'm going to make the base case assumption that it's a traditional cyclical bear market. And the reason I do that is because you don't have, if you look in history, crashes don't happen very often. So just the idea that you would even expect one is is really kind of going against the grain of what's normal. So bear markets are normal when they typically happen, they're 20%. These rip your face off, highly systemic bear markets, they're bear markets like that because they are systemic. Something's broken. And again, that doesn't happen often, particularly so close to a crisis that we just had. And I think the banking crisis that we just had in early 2023 is a good example of that. I mean, that could have easily unglued the whole market, but instead the market came, at least as represented by the S&P. Remember that the value line is still below where it was at the banking crisis high. But nonetheless, the idea is the way I prefer to think about this is that the risk of thinking about this is, well, it's only going to be 20%. So I'm not going to do anything, which is totally fine. I'm not telling you what to do. I'm telling you how I process it because I'm a tactical long-term trend follower. The way I think about it is if I have evidence that the market's going to go down 22%, 25%, that's all I need to know to take tactical steps to avoid that. If it goes lower than that, fine. I'm positioned for that too. If it doesn't go lower than that, I'm positioned for that too. And I can only tell you that when we were during the GFC, there was no way to know that that was coming. I mean, for me, at least from my perspective, speaking technically, of course, people that were super bearish on that whole thing were bearish for 5 years, and they were wrong for 5 years until they were right. But in the moment that it finally turned over, and the risk gauge, as I showed you, turned over, I guess you could have reason to believe that it could be worse than average, but there was no way to know that the GFC was coming. But if I waited to get the evidence that was coming, we would have missed the opportunity much earlier on to position for that, what ultimately became the GFC. So right here and now, I showed you the extremes. I showed you what could happen if these extremes actually come home to roost and they actually do end up mattering. In collection, they all, with Warren Buffett raising as much cash as he's raised, I just think that if you're going to take defensive measures, and if particularly if you're tactical, pay attention to that red zone I showed you, and if the SPY gets below 550, I think you really want to pay attention to that. And are there parallels to 2000 to 2002 where small caps outperform? Absolutely. Fantastic question. Um, I almost spent some time on this because I think that there's that possibility where the bulk of the decline comes from the stocks that participated most in the bubble. That's what almost always happens. In actuality, you asked the question about 2000 to 2002, which is a perfect analogy. But what we don't realize is that that actually happened in 2021 to 2022 as well, because the stocks that went up the most in that post-COVID work from home trade, those things went like even Meta went down 80% or so, while the average stock went down, 30%. So it was kind of your traditional cyclical bear market, but beneath the surface, the stocks that led that bubble beforehand went down the most, and some of them haven't even come back yet. Look at the ARK fund that's just barely coming up off the mat finally. So the idea is that what led us to this point has the greatest risk of leading us the most on the downside, and that's exactly what happened in 2000 to 2002. But it's also what happened from 21 to 22. Great question. I think we're done. I think those are our questions. As always, you guys have my email address. So please, at any time, feel free to reach out to me. And if you're not a research subscriber, please feel free to go to the website and get yourself a 1 month trial of the research. You'll be able to keep posted on what's happening with the risk gauge, and look forward to communicating with you more on this in the month ahead and months ahead, as I'm sure it's going to be an interesting time. But in any case, I want to just say thank you so much for joining us today. Hopefully you found it instructive and helpful, and good luck out there in 2025.